Welcome back to the Investment Diary. Today, we're doing a post-mortem on one of the most talked about new stocks in the AI space, Coreweave, ticker CRWV. This company just dropped its Q2 2025 earnings, and the results are a fascinating mix of blistering growth and significant growing pains. We're going to deep dive into the numbers, break down what they mean for the future, and look at why the market and analysts are so divided on this company. First, a quick refresher. Who is Coreweave? They call themselves the AI hyperscaler, and it's a fitting title. They're a cloud infrastructure provider that specializes in a single, incredibly high-demand product, GPU-accelerated computing. Forget general-purpose clouds like Amazon or Microsoft. Coreweave is built from the ground up for the intensive workloads of AI, from training large language models to rendering complex visual effects. Founded in 2017, they started in crypto mining before making a brilliant pivot to AI. Today, they're a critical partner for some of the biggest names in the game, including Microsoft, OpenAI, IBM, and Meta. Essentially, they're the picks and shovels provider for the AI gold rush, and their purpose-built infrastructure is their key competitive advantage. Now, let's get into the main event, the earnings. Coreweave delivered what can only be described as a monster top-line beat. Revenue, they reported a jaw-dropping $1.213 billion, a massive jump over 206% year-over-year. This absolutely crushed the analyst consensus of around $1.08 billion. Backlog, even more impressive, their revenue backlog, which is a great indicator of future growth, grew to an incredible $30.1 billion at quarter end. That's up from $25.9 billion just last quarter and shows the long-term demand for their services is not slowing down. But here's where the narrative gets complicated. While revenue was soaring, the bottom line told a different story. GAAP net loss, the company reported a net loss of approximately $290.5 million, which was significantly wider than the analyst estimate of around $190.6 million. However, if you look at non-GAAP metrics, the picture is much better. Adjusted EBITDA came in at a solid $753 million, or a 62% margin. This metric is crucial because it strips out some of the huge expenses related to building their infrastructure. CapEx and expenses. The main reason for the widening GAAP loss is the massive cost of scaling. Coreweave is in hyper-growth mode. They spent an enormous $2.9 billion in capital expenditures in Q2 alone and maintained their full-year CapEx guidance of $20 to $23 billion. These costs, along with rising interest expenses, are a direct result of their aggressive expansion to meet customer demand. Looking ahead, management raised their full-year revenue guidance to a range of $5.15 billion to $5.35 billion, a clear sign they see no let-up in demand. But notably, they kept their adjusted operating income guidance unchanged, highlighting the continued pressure from those massive scaling costs. Now, let's talk about the Wall Street reaction. And this is where things get really interesting. Analysts are all over the map on Coreweave. The average 12-month price target is around $90 to $110, implying significant downside from the current price. The consensus rating is a lukewarm hold. But if you look at the individual calls, you see some wild divergence. Citi's Tyler Radke upgraded the stock to a buy with a $160 price target, while JP Morgan is also bullish with a $135 target. On the other end of the spectrum, HSBC has a sell rating with a target of just $32. And finally, a popular DCF, or discounted cash flow model, from Simply Wall Street estimates the company's fair value at a staggering $251.12, suggesting it's massively undervalued. This wide range of opinions tells you everything you need to know about the company's risk profile. It's not a mature, predictable business. It's a high-growth, high-stakes bet on the future of AI. So what's the bottom line here? Strengths? Explosive growth. The demand for Coreweave services is insatiable, and they are executing flawlessly on the top line. Revenue visibility. The massive $30 billion backlog gives investors incredible long-term confidence. Strong margins, adjusted. Their non-GAAP margins show the underlying business is highly profitable, even as they spend big to scale. Risks, capital intensity, and debt. Building out this kind of infrastructure is incredibly expensive and requires massive capital raises, which leads to huge interest expenses and a wide GAAP net loss. Concentration risk. The company's reliance on a few key clients like Microsoft and OpenAI is a major risk factor. Any shift from a single partner could be a huge headwind. And volatility. With the upcoming lockup expiration around August 15th and such a wide range of analyst opinions, this stock is bound to be volatile. In my view, Coreweave is a classic high-risk, high-reward investment. The bulls are betting on the revenue growth and long-term backlog will eventually lead to economies of scale and dominant market share, justifying those higher price targets of $135 to $160. The bears, on the other hand, are focused on the GAAP net losses, the high debt burden, and the execution risk of scaling this fast. They see a company that's overvalued and vulnerable to any misstep, which is why we see targets as low as $32. This quarter, Coreweave proved that the demand for their service is real and they can execute on their growth plan. The real question for investors is whether they can manage the immense capital costs and debt required to seize this opportunity. That's it for our deep dive into Coreweave's Q2 2025 earnings. What do you think? Is this a buy, a hold, or a sell? Let me know in the comments below. And don't forget to like and subscribe to the Investment Diary for more analysis. See you next time.